Thank you so much. Hi, everybody. My name is Cho-Nan. I'm the CEO and president of Hyperion Software AI consulting firm. The topic of my presentation today is um, lending to the underbanked, what a decade of alternative data lending taught us. I promise to be quick. I know I'm standing in between you and the bar. Oh, I want to talk a little bit about my personal experience first. So about 4 decades ago, um, my parents had a little photo studio in the bustling streets of Taiwan. Those in the 80s, and things were doing really well for a lot of small businesses. My parents, they owned this company, and things were doing well. Everybody was happy, customers were happy. But at some point, they hit a snag, right? Um, their business needed capital in order to expand and sustain. Um, However, things were really rough at that time because banks wouldn't give us time of day. I was just a little kid that I remember really well. My father was getting very, very desperate, and he needed to get cash fast. And so he ended up working with a sort of shady person, and some people call them loan sharks, right? And they had this arrangement where he took out a loan. So the loans at that time were really bad because the interest rates was like 20, 30, sometimes even 50%. So within 2 years, my father had lost his business, our home, and our dreams. So we packed basically everything into a couple of suitcases, and then we took off, went to a new country in Malaysia, and we started all over. But we were still kind of facing the same problem because we were a new immigrant to this country. We couldn't access capital, right? And it was very, very challenging for us. So in my mind, that kind of planted a seed for me where I thought, why was it so hard always, right, for humble, hardworking people to get access to capital in order to work hard and grow their business? So fast forward to 2015, I was in Los Angeles in this time what we call the golden era of fintech. I was the CTO of a few online lenders at that time. So I basically had the front row seat to a lot of these companies and players in the fintech space. Um, and what I saw back then was something incredible, right? I was working in Los Angeles, in Boston, in Bogota, and some of these different places. But seeing these companies coming together, all these data providers coming together to tackle this financial space where banks traditionally ignore, that was eye-opening for me, right? And just kind of looking back in the last 10 years, a lot has changed. I would say we were very lucky. My company where I used to work as the CTO, we had an exit. Some of these other companies, mostly in the lending and fintech financing space, some of them actually went public and had become actually a household name. But unfortunately, many also went under because the changing interest rate environment becomes very, very challenging. So it was very bittersweet, that's for sure. But one thing I want to kind of highlight here is in the world of alternative data lending and credit in general, especially in the eyes of banks, there is this one simple formula, right? Literally, if you don't have any formal credit scores, you don't exist in their eyes. If it's very, very difficult for a bank to give you a loan because simply because you don't have any prior records. For them, it's all about underwriting, right? It's all about human judgment, right? And looking at some past historical performances. So if you look at this survey, this is actually a survey from FDIC, and in the grand scheme of things, this is actually a sort of survey of mainstream credit products among the fully banked, underbanked, and the unbanked, right? So the fully banked and the unbanked, they all have very similar statistics about who can have access to credit data, right? Credit products. So obviously, traditional credit card, auto loans, they have access to that very easily. But for people that are actually unbanked, they don't have such luck, right? Their percentage for household that can access that is usually less than 10%. The only thing they have access to is no mainstream credit, right? Which means some type of predatory lender, or maybe relatives that's willing to offer them some cash loans. So really what this means is there is a vicious cycle, right? You don't have credit, then you can get a loan, but if you can't get a loan in the first place, how do you build your credit? It becomes very, very challenging at the end of the day. But this is where some of the fintech lenders saw an opportunity, right? Where banks don't want to serve this impossible, difficult market, what we call subprime. The fintech lenders, they're actually willing to use things like machine learning and various AI tools to make sure that they can do really well with the portfolio they have and yield a very profitable outcome for themselves. So in the beginning, at around 2015, this is when fintech lending started. The banks were surprisingly welcoming to the fintech lenders because for the banks, they didn't have any sort of regulatory burden or reputational risk. For them, it's just like a partnership, right? So they were willing to see what the fintech lenders could do. But then a lot of these partnerships turn out to be very awkward, right? Because the banks, they talk a very different language. Sometimes they just refer to things like, oh, we just need to see credit reports, credit scores, and then some human judgment by their underwriters. But whereas a lot of times the fintech lenders, they're talking about a data approach to underwriting, and then also a very sort of data centric to everything they do in the business, right? Which I'll get into more. So at the end of the day, in order to do alternative data lending, you need a fundamentally different approach. I've done this a few times in my career already. But if you're an online lender, you usually have a setup or tech stack that looks like this. Typically, you work with different data providers that will provide, data or information about these borrowers, and then you also take in information from the borrower themselves, right? And then, of course, working with structured and unstructured data, building out usually some type of credit risk model to say, oh, should I lend this person this loan at this amount or not? But in fact, there is usually quite a number of models that you would build in a lending business. Sometimes it is a fraud detection model. Sometimes it is renewal propensity, right? The likelihood of somebody to renew a loan. And then also collection optimization model, right? So these are just a handful that are most common. And then, of course, the concept of challenger and champion models are essential because you don't want to just throw a model out there and then let it sit forever, right? You always kind of want to come up with something that might eventually get better and swap it out down the road. And then also eventually you need to kind of have an overview of things. So data visualization is very, very important. You need to kind of have dashboard for everything so that people that are running the risk department or collection department can see exactly what's going on. So at the end of the day, it is a somewhat intelligent system where you could really adapt to changing things in the business environment. So some of the really key insights that will shock some of the traditional lenders, such as banks, would be, we take data very seriously, right? So one of the things we do a lot is device fingerprinting, right? So a lot of times a fraudster would apply for loans using one device, right? And they could be applying using different names all from one device. So we can detect fraud very easily by device fingerprinting. But the most fascinating part is if you look closely at some of the UI interactions between the borrower and the loan application itself, and also kind of the keystroke patterns, right? You start to see these very interesting behaviors emerge, right, between good and bad borrowers. Like typically, it was a good borrower will spend time reading everything on the online application form, and will carefully think about things before they enter those numbers. A bad borrower, on the other hand, they may be just skimming through everything because, you know, at the end of the day, they just want to get some money and run, right? And then the other thing is, at times, the bad borrowers could be using some type of automation tool just to kind of fill out all the forms and submit and try to get something out of it. So this was very very eye-opening. But what really worked for us, I think, was kind of figuring out, you know, who is this person sitting behind this loan application, right? These psychometric profiles of these people tells us a lot about them. What is, you know, who are you really, right? What do you do on a daily basis? Do you work, say, in uptown and live in downtown, or the other way around? And so, and we also ask, like, do you have, the other question we ask a lot is, do you have a kind of stable social network that you go to at all times if you need support? So once you figure out a lot of these things, in fact, lending becomes a lot easier. But you're going to ask, like, how do you do this, right? So what's the one thing that tells me most about you? So besides the clothes you're wearing, the keys, the house keys you're carrying, you know, mobile device, and the data that sits in it are probably something you carry around at all times, right? And that is sort of like the thing we get a lot of insight about our borrowers. Specifically, like, you know, things like location data is so useful, right? If people are lying about where they live or where they work, we know that kind of right away. If people have really have people that they talk to often, we can actually see from their call history. So there's a lot of things that you can actually tap into. One of the markets that we service, we found that, you know, the borrowers that call their mothers the most are actually the best borrowers, because they're the ones that will pay back. Even if they don't, the mother will help them pay back. So, but there are other things that we didn't do too well. I think some of these failures were very hard lessons, and it really cost us money, right? But then he also taught us a lot, and I'd love to share with you. So one of the things is, you know, we can't really follow data blindly. I think we always needed to take context into consideration, because a lot of times, you know, a lot of these borrowers are coming from online traffic. If you're kind of working with, you know, a new partner that kind of came out from nowhere, sometimes you don't know too much about that traffic. So the model that you've trained on a different data set may not be totally applicable with the new traffic coming in. So it may give you kind of a false prediction with regards to their creditworthiness. The other thing is, sometimes I think the best part is when you combine human judgment and the power of machine learning, that yields actually the best outcome. Because sometimes, you know, there are people that are in the business for a very, very long time, right? And so their gut instinct coupled with everything that's being monitored will actually help them, you know, seek out new patterns and new opportunities in the market as well. And so that brings me to this, to some of the things that we want to share, which I would say is sort of an uncomfortable truth about the lending business. So in general, I feel like a lot of times we are kind of operating in a gray area from an ethics perspective. In the U.S., so the practice of redlining is actually illegal. This is a practice where you are systematically denying people that are living in a certain area. But we have service clients, you know, outside of the U.S., and for those regions, it's fine to use this method. And so this is like a map of Bogota in Colombia, Latin America. And, you know, we've had prisoners applying for a loan, and we knew right away because the GPS location tells us, and we would deny them, right? So those are very strong indicators. But at the same time, this is also giving us, in some ways, reinforcing inequalities, because people that live in bad areas probably would never get a good loan or a loan at all, right? The other thing is with respect to payment collection, which is also very key in the lending business. There are situations, especially in countries where there's a weak legal system, a lot of the collectors may resort to other means to collect money. So violence do happen from time to time, and sometimes violence could also happen to the collectors themselves, right? So it becomes a very, very tough thing to kind of deal with. But kind of looking forward, I think what we're going to see is there's going to be more personalization of lending products for people. It's not going to be sort of just kind of one loan product for everybody, right? We'll be able to kind of give individualized offers based on somebody's data. The other thing we're seeing is compliance tech is actually becoming more and more mature, and we know also regulators are becoming more tech savvy, so they're going to be able to kind of catch some of these compliance issues early on. And because of Gen AI these days, digital twin is sort of like a big concept. So that data that's being generated from digital twin can also be used for underwriting purposes. And embedded finance is kind of related to buy now, pay later, right? So people don't always have to go get a loan in order to get access to credit. Every transaction is an opportunity actually to get capital. So that's kind of, my presentation. I think at the end of the day, I feel advancement and future of finance is really not about replacing humans with AI. I think at the end of the day, we need to really leverage these tools to augment human potential in every way, and ensuring equal access to credit for people like my parents who want to work hard and build a wonderful life for themselves. Thank you so much.